Hello and welcome back. My name is Josh and this is Finance Soup. And today I wanted to go over some investing basics. If you're interested in this sheet, I wrote up a sheet for some friends basically because they all say, "Hey Josh, you kind of know what you're doing when it comes to investing and saving. Do you have any suggestions?" So I wrote up a short, I think it's 7 pages document. If you are interested in me sending you this document, just subscribe to the channel and leave me a comment, and I'd be happy to send it over your way or share it with you. Um, yeah, so I just want to go over a couple of the basics in a very short video. So just to go over, let's start with the basics. Why do we invest? Well, we invest to make more money. When you work, you sell your time to make money, but investing is about putting your money to work. So your money is then working for you. That's really what it's about. You don't want to have to work forever, so you put your money to work. Without investing, it'd be really difficult to retire or make any major purchases, such as a house. So this is why we invest. Invest so that we don't have to work in the future, whether it's or to get things that we wouldn't otherwise be able to. Um, so if we look at investments, there's two main kinds. There's fixed assets, like a bond, or equity, which is ownership. There are what I'll call alternative assets, so that would be Bitcoin and stuff like that. I'd love to discuss Bitcoin and cryptocurrencies another one, but for the most part, let's focus on the main ones, fixed assets and equity. Equity is stock. Really what you're doing is you're owning a piece of a business. And a business, the goal is to make money. Obviously, if you have a business, if you started Apple, you've done very well. Why? Because that business has made tons of money. So as an owner in that business, you get a small profit. You get a right to the profits that they make. Meanwhile, a bond, by comparison, um, is really a promise from someone else that they'll pay you back. So a mortgage is my favorite example of a fixed asset. Really, you're taking money out, so the bank is loaning you money, and you guarantee that you will pay it back along with some interest. Um, Bonds are much less risky because if you don't pay your house, the bank will take your house as collateral, so they know that you're going to pay them back likely, and they're also fluctuate much less, because they know, hey, this person said they'll pay me a 3% interest rate over the next 30 years, so they can kind of, it's very sure what you're going to get. Stocks, obviously, a stock can do well or poorly based on the company. Companies do well and then they do poorly. So that's the main difference between those two. Um, let's go over to, I go into more detail about, actually, this one's a good one. What's the rule of 72? So when you're trying to look at an investment, um, I always use this thing called the rule of 72. So it's how long it takes to double your money. You take the number 72 and you divide 72 by the interest rate you're going to make. So if you think you're going to make 7% a year, it's going to take about 10 years. So 72 divided by 7 is about 10. Again, this is an estimate. Obviously, if you had a calculator, you can check investment calculators and see that, but roughly it'll take 10 years to double your money. How about if you made 10% a year? It take roughly 7 years. This works for most numbers, 4 to 20. It breaks down at the extremes if it's 1% or if it's, you're making hundreds of percent. But this is a good idea of how long it'll take you. So if you said, hey, I have $100,000, I needed to get to $400,000, so you need to double twice, and I'm growing at 7%, you could say, well, it'll take 20 years for that money, just not touching it, to get up to 400,000. So this is where the rule of 72 is. That's useful. And there's a thing called the 4% rule. Basically, you can take out of any investment about 4% a year, and it will basically stay the same. Because yes, it will go up 7%, but you have to pay taxes, and there's volatility and stuff. So if you had a $100,000 investment every year, theoretically, you could take out $4,000 if you wanted to, and the investment might go up a little because now it's down to 96,000. So if it goes up 7%, it's still around 100,000. Again, it'll fluctuate a little based on whether it had a good year or a bad year, but in the long run, it'll stay about the same. So this is good to know for saving long term. If you say, hey, I want $40,000 a year in retirement, well, if I get $1 million, I can take out 40,000 per year based on the 4% rule. Okay, so now let's talk about investment philosophy. Great investing is about buying amazing, high quality businesses at a fair price and holding them for the long term. That's my philosophy. This is when I have my the three things I look at is it a great business? Does it have tailwinds? And is it a fair price? Again, I don't need like there are businesses sometimes that are really well priced, but maybe it's a shitty business. I would not buy a really bad business, even if it was at a good price, because you never know, the business could collapse. Sometimes it's worth it. That's not my investment philosophy. My investment philosophy is buy great businesses at fair prices. So, what makes a great business? You have to answer that yourself, but to me, it's product. Does it offer value? Do people like it? Is it showing revenue growth? That's a good sign that it's continuing to be a good business. Um, so again, it could produce something people love, like Apple, massive growth, like Tesla, or a business that sells its products for much more than expenses, like Coca-Cola, which really just sells sugar and water, and so it has high gross margin. What's a fair price? This is harder to answer, but this is why we use some of our mathematical frameworks, such as discounted cash flows or PEs and exit multiples to try to understand a business. So, whenever you're looking to manage your money, you have three ways. You have one, you can hire a money manager. They will take a fee, but they will recommend stocks and bonds to buy. I actually think this is a good idea if you, A, don't want to take the time, or B, um, you are not emotionally equipped for this. And this is a big thing. I'm not knocking anyone, but if a stock goes up 20%, everyone feels great. But when it drops 20%, people can make really bad decisions. And, I typically like to buy when it's dropping. There's a famous line by Warren Buffett, be greedy when others are fearful and fearful when others are greedy. In other words, when the stock market's ripping higher and everyone's loving things, maybe you should be selling a little and getting into cash because it might pull back. And when things are going terrible and it's dropping, that's when you should be investing because that's when you're going to make big investments. Just as an example, S&P 500. If we look, I did a lot of investing here when the stock market during the pandemic dropped 21%, and a lot of people made a lot of money during the financial crisis when it dropped 50% because if you it quickly went on a tear. So this is what he's saying. So if you don't have the ability to make these emotional decisions, it's good to sometimes have someone else make those decisions for you. The second option is use a robo advisor. I actually really like this way. Basically, it takes a smaller fee, and money managers take a decent fee, and it can really eat into your returns long term. Um, but you have to be comfortable with technology and you have to be comfortable with the strategy they set up. But basically, a lot of them just say, "Hey, let's just invest in SPY, which is the S&P 500, and you can set up every month, pull every week, pull $50 from my account and invest it, and it'll automatically invest whether it's doing well or doing poorly, and that's called dollar cost averaging when you're basically investing the same amount every week, and some days you're getting good deals, some days bad, but in the long run, you're gonna do really well. Um, or the last one is invest in ETFs. What's an ETF? Exchange traded fund. That's like I said, SPY. It's a well regulated portfolio. So it basically diversifies. It says, hey, I want to own all 500 companies in the SP 500. That's an example of an ETF. There's other ETFs that are more thematic. You say, oh, I only want to own biotech companies. I only want to own airline companies. There's an airline ETF. So that way you don't have to pick individual companies and say which of these companies is going to do well. You can just buy all of them. There's very niche ones now too. There's ones that are only companies that are started and still run by the founder. There's companies that recently IPO. There's companies in, ARK is an ETF. So that's an innovation forward ETF. So it's companies that are trying to that have lots of innovation behind them. So if you want a theme, is that if you say, I think biotech's going to be big, or e-commerce is going to be big, or gaming. There was a gaming ETF I used to be invested in. So this is a good way to invest. It does take a little more work on your part to invest, but there's a fourth one, which is invest in individual stocks. But I think this is really for beginners. Again, it's called investing basics. So if you're starting out, these are the three ways I would recommend. Here I talk about what an ETF is. So here's my tips for good investing. One, invest early. The sooner you start, the way less you need in the long run. A one-time investment of $10,000 earning 10% per year will be worth basically $100,000 in 25 years. But $255,000 in 35 years. So that extra 10 years resulted in an extra $160,000. So again, if you're investing at 20 versus 30, it can make a huge difference. So start investing now. Two, invest often. Try to contribute on a, like I said, dollar cost average. Do a little bit each month, each week, whatever it is. Some people try to time the market. You really can't. Sometimes you get lucky. I happen to have a little bit of extra cash when the pandemic hit, and I was able to deploy a lot of money at that time. But there were people that were calling a crash for years, and between 2020, or sorry, between 2009 and 2019, 10 years, it basically you never saw much of a dip. So people can try to time the market, but sometimes you miss out on a huge run in the meantime. So don't try and time it. Invest early, invest often, and think long term. Again, that means if something's down a little, don't sell necessarily, unless you think something fundamentally has changed. But things go up, things go down. Think long term. Where's this going to be in 5, 10, 15 years? This is still a good business. And my last thing is ignore everyone else. Here it says, when others are fearful, be greedy. When others are greedy, be fearful. The market freaks out about little things all the time, and other people tell you tips and strategies. Try to just ignore all that, have a strategy in place, and stick to it. Set expectations. What do you expect? Don't expect 30% returns. We've had an amazing bull run here, but do you expect to have, in 1 year, the S&P 500 has gone up 39%. That's way more than average. Again, it goes up about 7% on average. That doesn't mean it's 7% every year, but some years 7, some years 20, some years -5. So have realistic expectations, control your emotions. I was lucky I invested in Tesla, but some people were early on GameStop. Don't go chasing gains. Don't get FOMO. Control your emotions. It is good to reduce taxes. So if you have a tax-free savings account, TFSA in Canada, or a Roth IRA in the U.S., make sure you're investing in those ones first, rather than in taxable gains. But tax is not the number one thing. It's you always want to try to reduce them, but it's better to have a good long-term investment in a tax account than trying to. Sometimes people try to save a penny by selling and doing all this crazy shit just to reduce their tax liability. It's typically not worth it again. And risk management. Know what you're willing to invest. Again, I invest in crypto. I am a fan, but I don't have 100% of my holdings in crypto. Make sure that you are weighing your risk. Don't have too much of your investment in one asset, because that company could go down. So try to weigh things equally. So I typically do I do what's called a barbell strategy. So I do 80% large safe companies or ETFs and 20% risky assets. So that means if you want, you could do 80%, a SPY ETF, and 20% you say, I'm going to go buy Bitcoin and Tesla and GameStop. And you know what? It might not work out, but you know what? Maybe you get worse returns in the long run. Maybe you get better, but you're not going to risk your whole life savings over it. So I think that's good for now. Hopefully this was helpful. Again, this is my recommendation if you're just starting out and trying to understand what investing is. Here's my recommendations. Again, just to recap, if you do want this document, comment down below and I'm happy to share it with you. And again, we're talking about it. Typically, I invest in stocks, which is equity, so ownership, but there are also bonds. Bond rates right now are very low, so I really don't think most people, especially young people, I'm assuming are the ones watching on YouTube, should look at it, because they're very safe assets. So if you're old and you want to protect your money, it makes more sense. But for 20, 30, 40, you have lots of time to save, so don't worry about it. You're going to see lots of drawdowns. You're going to see times like in COVID where you see a massive drop off, but you can more than make up for it because you got time to wait. If you're a retiree and you need money now, or you're looking to buy a house in the next 6 months, don't invest all your money. That's my thing. Think about your time horizon. So again, the longer the time horizon, if you can think long term, you can sit through all the volatility. If you need money now, like you're a retiree or you are making a major purchase, don't go chasing gains. Look for something safer. So that's bonds, or maybe even a stock or an ETF with lower volatility. And bonds have lower volatility. Thanks so much for watching. My name's Josh. This has been Finance Soup, and talk to you next time. Bye.